In today's video, we'll break down Dave Ramsey's retirement plan and figure out if it's as good or as bad as it sounds. So I've been at the front lines of helping hundreds of retirees securely plan for their retirement over the past 15 years. And in that time, a number of different rule of thumb retirement plans, such as Dave Ramsey's, have popped up along the way. The truth is, the retirement advice that you hear for the masses will never be perfect for you, but there may be bits of that advice that are more suited to you than you think. And comparatively, other bits of advice that you should avoid at all costs. So that's exactly what we're going to be discussing in today's video. So in this video, we're going to go through some of Dave Ramsey's advice and figure out if it's really as good as it sounds. All right, so Dave Ramsey suggests that you should retire with a 100% stock portfolio, and you can earn a 12% annual return, which will maintain your principal while spending 8% of your total portfolio each year. So this means that you might have $1 million saved and spend $80,000 per year, and from it, it'll still grow your portfolio over time. Now, if you compare that to what you might normally hear from academics and planners, they say you should retire with a 60-40 portfolio, stock to bond in general, or some variation of that, and that you can earn an average of 7 to 8% annual return, and that you would spend 4% of your portfolio each year, plus give yourself those annual inflation adjustments. So this means you might have $1 million saved and spend only $40,000 each year as compared to Dave Ramsey's $80,000. And in his now infamous podcast episode, Dave goes way over the top to criticize planners and academics who he calls super nerds, goobers who live in their mother's basement with their calculator. The well-respected Dr. Michael Fink called Ramsey's rant next level hate on good advice. As you can imagine, all the heat and controversy stems from Ramsey's sensational claim and the obviously big difference in recommended numbers. When I first heard the claim, I was in disbelief. I mean, after all, Dave's a popular guy. He's well respected for helping people finally break the cycle of debt. That's something that I don't think anybody can deny. But is Dave calling me a goober who lives in my mother's basement with my calculator? So we're going to talk about the strengths and the difficulties. Let's start with the difficulties first. So the first one is the difficulty with the math. When Ramsey claims the average return can be 12% in stocks, and that this allows you to spend 8% per year to live on, he's using a form of the average return that academics would not use in this application. He's talking about the arithmetic average return, but academics say that you should use a geometric average instead. There's a huge difference between the two. In retirement income planning, geometric returns are more accurate than arithmetic returns because they better reflect the long-term performance of an investment, accounting for volatility and compounding over multiple periods. And here's why. If your portfolio loses 50% in 1 year and gains 50% in the following year, your arithmetic return would be 0%. However, your geometric return would be negative 13% because it follows the actual decline in value. So if you started with $100 and you lost 50%, you're at $50. And then the next year you gain 50%, you have $75, not $100. The $100 that you started with is worth $75 in year 2, but you got an arithmetic average of 0% return and you're still down $25. If you combine the math error with the next difficulty that I'm going to talk about, which is the riskiness of such a high withdrawal percentage, and you have catastrophic problems. The simplistic anecdote of earn 12% and you can spend 8% doesn't account for sequence of returns risk. So follow me on this. He says if you get a 12% return and inflation is 4%, then you can safely spend 8% per year and even go as far as maintaining your principal. I almost feel like we're joking here. I mean, it's hard to keep a straight face when you say this because you can't get a reliable 12% return in the market. And even though his website says you can, the 12% arithmetic return that he claims is actually about a 9% geometric return. And add to that Vanguard recently downgraded the next 10-year outlook somewhere between 3.7 to 5.7% in equities. But let's go with 12% for a second. He says that you can get a 12% return and inflation is 4%, so you can spend 8% per year. But here's the rub. You lose principal when you have bad years. And this is why the nerds in the basement came up with the 4% rule. Now, I'm not saying the 4% rule is perfect. In fact, I bring up other better ideas to take retirement income all the time, and I criticize the 4% rule myself. But the challenge with starting at 8% and staying at 8% should be obvious to any slightly critical mind. So can you spend 8% in certain periods of time? I think so, yes. But from what I've seen, I would never put a retiree on an 8% spending spree for life. According to academics, these mathematical errors create a mixed bag of results, leaning greatly towards failure. David Blanchett, a well-respected PhD and financial analyst, commented about Ramsey's ideas, and he said, to be clear, some investors do get really lucky because they retire in a fantastic bull market and their investments go up 10 or even 20%. But his colleague, Dr. Wade Pfau, pointed out that if a retiree actually listened to Ramsey and followed an 8% withdrawal rule by holding a 4-fund stock portfolio in the 2000s, they would have ran out of money in as little as 13 years. So next up is the part of Ramsey's plan that has the retiree investing in 100% stocks. So to get the supposed 12% return, this would infer that you have 100% of your money invested in stocks throughout retirement. Now, I personally like the idea of retirees holding more stocks for the length of retirement than is typically talked about. And I think it's important to hold stocks for the long term because most retirees should view themselves as having a long time horizon, and dividends from stocks tend to outpace inflation better than anything else. So this might look like a 60-40 or even an 80-20. And I wish that more advisors and influencers would talk about the wisdom of doing this. But I have to say that human behavior struggles with owning a lot of stocks, and especially 100% stocks. We hear a lot of people talking about the fear of market crashes and the pending doom coming for anyone who wants to get your attention in articles, videos, and newscasts and throughout your social media. And we're told that retirees can't afford risk and that the system is going to fail. But we don't hear people talking as much about the risk of inflation taking your lifestyle away over time. In fact, we're sold a bill of goods about how you should put your money into gold so you can hedge against inflation, which is completely untrue. At least for the last 50 plus years, it hasn't helped. So even though I'm somewhat glad to hear someone like Dave Ramsey talking about owning stocks in retirement, owning stocks and companies is something that should be treated with a sober mindset and respect, just like driving a car. A car can get you from point A to point B, but if you race it down the road like some of these new drivers do, somebody can get hurt, maybe even killed with it. And the number one killer of retirement portfolios is when you make the big mistake. The big mistake is when January of 2015 comes around and the market drops 4%. The analysts are saying that it's a bad start in January and that means bad things are coming. And then you adjust your portfolio from stocks that you own, you lock in that drop, and then you move it back to where it was because you're feeling better later in the year. And then December of 2018 it happens, and the S&P 500 drops 9.2%, and analysts are calling it the worst December since the Great Depression. So once again, you sell away from your ownership of stocks, and what happens in January of 2019? A V-shaped recovery, returning the market back to where it was and even reaching new all-time highs. And you just repeat until you're broke. If you want to stay the course, you need to believe in your portfolio, and most people, especially people who retire, tend to be more jumpy and prone to making these mistakes, and it's hard to imagine a 100% stock portfolio for a retiree, or at least for the vast majority of people. But as a quick aside, the thing is that this is really a small part of everything you should be looking at for your retirement, everything we're talking about here. So if you want to learn more about how to build a full retirement plan from scratch, click the link in the description after this video. As dangerous as the Ramsey plan is, I think there's a reason that it appeals to so many people. There's a reason why suggesting these ideas gets a crowd to listen. I mean, the simple 8% withdrawal rule appeals to the average person who's looking for that straightforward advice. 8% is definitely more exciting than 4 or 5%. Assuming an optimistic 12% return might be motivating to people and actually encourage them to save more aggressively for retirement. Maybe that's a possible silver lining here. The promoting of a 100% stock portfolio, especially for the younger people, could have a positive impact on how much wealth they actually accumulate. But if you're not into gambling, and if you hate the 4% rule like I do, then here's what you can do instead. First off, we all want to be simple, but it's not. Not if you want to be safe and get the most from your money. Here's why it's not simple. The market can change and the withdrawal percentage should change. You see, the long-term market might be reliable, but the short-term never is. Just as I mentioned, Vanguard's recent projection for the next 10 years shows more than a few percentage points lower than the 9 to 10% geometric average return that it normally gives over the long term, so you need to account for that. And then your withdrawal percentage should change because as you get older, the risk of running out of money goes down. So if you start your retirement with any static percentage and you base your entire retirement around that number, you're either going to go overboard like Dave's plan, or you're potentially going to underspend like in the case of the 4% rule. So what I'm talking about here does not mean that you're going to have a variable income. It means you're going to have a steady income, and you can use a method that simplifies something that is actually pretty sophisticated. You may have heard me talk about the risk-based guardrails approach to creating the steady monthly income in retirement, and I like it because it answers a problem that the 4% rule is trying to solve. The 4% rule exists because you don't want to be the person who doesn't win the retirement lottery and you end up retiring during a bad period. We're not into gambling like that. So for example, if you retired in 2009 and the market just went gangbusters for 14 plus years like it did, congratulations, you have a ton of money left over if you used the 4% rule. But if you retired in 1963 and the market would really not pick back up again until the 1980s, well then you might barely get by using the conservative 4% rule. The risk-based guardrail method measures your true spending capacity based on near-term and long-term capital market changes and your growing age. It calculates the future cash flow needs in relationship to multiple data points, and it simplifies it by giving you very simple instructions. It simplifies things because it tells you what that steady monthly income can look like, but it also notifies you when it's okay to spend more, and it also notifies you when things have changed and you need to reduce that steady monthly income down. So an 8% withdrawal rate might be permissible, but a lower rate might be required, and these modern guardrails are an easy way to have that steady monthly income, but to be aware as time goes on and to be willing and able to adjust if things do change over time. Now, I'm not able to give you much detail about these modern guardrails in this video, but I do talk about them in more detail in a video that I've linked in the description, so be sure to take a look at that. So let's look back at Dave Ramsey's retirement plan. It's interesting to point out that I don't know any academic that approves. And I don't see why Dave would think that math nerds are bad, especially when it comes to moving numbers that are so important. I mean, maybe there's a silver lining here, like encouraging people to use more stocks, but for the most part, I think it's dangerous advice. And if you Google around, I think you're going to really not find any support in favor of suggestions that he's making. So now you know the truth about Dave Ramsey's retirement plan, and if it's as good as it sounds, you can move yourself forward and develop a better, more secure financial plan for your retirement. If you're looking to take it a step further, click the link in the description and watch the next video that talks more about retirement planning in general and dives in a little bit deeper.